Is financial debt good? Yes. If you don't misuse it or understand how it works, most people have some sort of financial debt. Some examples: credit cards, mortgage, personal loans, student loans, and the definitions of each one of these. Credit card, some good things about it. It's good for budgeting, paying your bills, and even get, quote, rewards for purchases made depending on what card you have. A mortgage, a loan that is used in the purchase of real estate if the buyer cannot or does not want to pay for the full price of the real estate. A mortgage is used to finance the property so monthly payments can be made over a specific time frame. Personal loans, used to combine all of your debts, usually credit cards, into one amount with a fixed interest rate and a monthly payment over a specific time frame. Student loans, used for students in a university setting that want to earn a specific degree but cannot afford the total cost. Bad reasons for credit cards: one, high interest rates, so it's bad for long-term expenses. Misuse can bring financial disaster, then could lead to both mental and physical health problems as a result of being in financial distress. Each one of these has their own purpose, and credit cards in particular, they're good if you get behind, or not if you get behind, but more if you have to watch your money more and you're living like paycheck to paycheck. So you can carry your balances over to the following month as long as you get the minimum payment made each month. Typically, what credit card companies will do and how they'll justify their high interest rates is usually through the introductory offers. So some banks, depending on which one, of course, all have their own programs that can offer you a new credit card if your application is accepted and you get the line of credit, meaning you don't have to pay. The offer can consist of all purchases at zero interest for, let's say, 12 to 15 months. Just depends on the bank, really, and their own offers that they come up with and whatnot. Those are good. However, there's other credit cards as well. We can go more into the different types later on in another video, but they're definitely there to help, just like anything else. But people tend to, people that get into financial trouble, anyways, tend to go buy things they're not supposed to be buying or living above their means. So they're never able to make more than just the minimum payment. So it just keeps on adding up, and they keep on getting credit cards and putting their old balances onto the new one. But it's a whole other thing. The mortgage, if you're looking to create your own wealth and create assets, I mean, a piece of real estate is an asset, and that can open up the possibilities for you to be able to create wealth for yourself. I mean, let's say you buy a house, and let's say 2 years down the road, the market happens to be going up, and you get your house revalued, and let's say it's worth $20,000 more than what you bought it. That's a simple example, but if that financial product, being the mortgage, wasn't available or not even created, then that person might not have been able to buy, say, that $100,000 house, because not everyone has $100,000 just sitting around. Typically, everyone needs some type of financing. Most people have a lot of financing, but that's another thing. Personal loans, let's say you have like 6 credit cards, all with different interest rates. One's 16%, The other one's 20%, another one's 25%. You get the point. What the personal loan will do, it'll go ahead and give you the money and you pay off your credit cards, meaning the credit cards with the different interest rates make their balances zero, and then you just owe money on the loan, which is the money that you use to pay off those credit cards. But then those loans usually have like a fixed rate. So instead of all these different interest rates, let's say you get, I don't know, making things up, let's say 17% fixed, meaning you're not going to be paying 17% 1 month and then, I don't know, crazy example, like 20% the next month. It's going to stay at 17%, and all loans have a time frame. So whatever the time frame is on the offer that you get, usually you get, if you're getting credit card offers and stuff, you're going to most likely be getting these as well for personal loans. Student loans, of course, they're targeting students, whether they're going to a four-year university, trade school to be like a welder or a machinist or something along those lines. Student loans are available. Usually, let's say the ideal customer for that, meaning the borrower, would be, say, like an 18, 19-year-old student that just graduated high school or fresh out of high school. So typically the average 18, 19, 17-year-old, but you have to be 18. No, not 8. Point is, fresh high school graduate, they usually don't have credit, so you'll need someone to sign their name on the loan, meaning co-sign. Typically it's going to be like a parent, guardian, or grandparents, another person, and they'll be able to get the money. So a lot depends. Like if you're just getting it for a regular four-year university, like say a state school, your loan could be about like $5,000, let's say, for a semester, maybe 2 semesters. Then when you get into, say if you go to grad school, so get your master's, or you want to become like a doctor or a lawyer, that's where the student loan amounts really increase a lot, and typically on the news, and that's the outrageous numbers is from the graduates that went to, say, like an Ivy League, like a Harvard or like a Yale, and they're taking out $50,000 a year for school. But for a state school or not as big of a reputable school like a Harvard or a Yale, your student loans shouldn't add up to that much. There's a lot of financial aid, both for merit-based and government-based too, via the federal government and the state government. And there's a plethora of ways to reduce your student loan burden. So at the end of the day, the financial debt is good. The general consensus of most people is that it's not good. However, a lot of things in society wouldn't be what they are if it wasn't for debt. Like, of course, these examples here that we talked about, they're just small examples. I mean, you go into Wall Street and they got different financial products for all these high-level investment bankers and hedge funds and whatnot. That you take debt from one pool of investments and use it to finance another investment, and it goes on, and it's financial engineering, really. That's what it is. And it can become a maze, literally like a maze of different types of debt and payments being collected from different funds, individuals, companies, countries, you name it. And it's essentially what's keeping the whole financial system intact. So debt's good. The general consensus of debt, though, has a bad connotation because people don't typically, psychologically, people don't like to owe anyone anything. So you always hear these stories too on the news that so and so is in so much debt, or you hear the stories, you know what they're about. But you need debt in society if you want to move forward and to actually progress and create something. So that's a little bit about debt, financial debt. If it's good, yes, it's good. Just don't be dumb with it. And we can go into more details on the different types of debt and whatnot, and just go over not only that, but calculations too, to go ahead and figure out numbers for different products and whatnot. But anyways, that's it for now. Thanks for listening, and catch you guys in the next one. Later.